By the end of this video, you'll know exactly how to safely grow your nest egg, protect it from market losses, and guarantee you'll have more than enough money to live out a happy and comfortable retirement for the rest of your days. How does that sound? Hello there. I'm John Stevenson, also known as the Guaranteed Retirement Guy. And I want to welcome you to this info session because after 2 decades of advising retirees, I can tell you without a doubt that the way most people prepare for retirement is flawed. So without further ado, let's dive into why with money mistake number 1, not knowing your numbers. This one is obvious, right? You can't accurately plan for future financial needs if you don't know your numbers. Start by asking yourself questions like, what age do you want to retire? How long do you expect to live? How much do you spend monthly on average? Will you retire with debt? Credit card bills, maybe a mortgage? How's your health? How much should you set aside for future out-of-pocket prescriptions and the medical costs that come with aging? Do you plan to maintain your current home, move back to the countryside, or downsize to a small condo on the beach? Would you like to completely replace your salary, or can you happily live on less? Will you outsource home-related tasks that become more difficult with age, like mowing the lawn or cleaning the house? Do you want to travel more? How much will you and your spouse receive from Social Security and pension benefits? What other stable sources of income or savings will you have access to? Have you factored in inflation, among other questions? Knowing your numbers is the first step, and it pays off to discuss this with a retirement planner early on, because we can help you anticipate future scenarios, making more realistic calculations and plan for situations you may have overlooked. Now, most people wait way too long to look at the numbers. It's why so many of my clients come to me a year or 2 before retiring or having recently retired, and they're panicked because they just realize they won't or don't have enough cash coming in to cover basic living expenses. Others are in this "I hope I'm dead" situation. My client Edward, for example, had calculated that if he withdrew $1,750 a month from his 401k, that's only $21,000 a year, by the way, the money would last him until about age 85 before zeroing out completely. When I asked him, "What then?" he answered, "Well, I don't know. I guess I hope I'm dead before the money used up." That's not a financially sound strategy, if you ask me. Luckily, Edward reached out because we ended up taking that 401k and rolling it into the guaranteed lifetime income investment I'll share with you shortly. And as a result, he increased his income from $21,000 to $33,000 a year. That's a bump of $12,000 annually. And he started getting a guaranteed retirement check that would keep coming month after month for as long as he lived. So he no longer had to worry about the what ifs or wish for a timely death because his money would never run out. It's also worth mentioning that even if you do plan and prepare for every foreseeable scenario, life still throws curveballs. What if you live 5 years longer than you expected? Or what if you discover a chronic heart condition and those extra medical bills eat up your fund faster than you planned for? I think we could both agree that the future is unpredictable, which is why knowing your numbers is only a starting point. But before we move to money mistake number 2, I have a quick quiz for you. When you retire, would you rather have A, a pile of money that diminishes over time, or B, a steady cash flow that once turned on, never stops flowing? Obviously, most people choose option B. The never-ending cash flow, right? In fact, studies around happiness and retirement support this. People who get a regular retirement check, like from a company pension, are happier than those who rely on a lump sum of cash in savings. And researchers speculate that this is due to the sense of security that comes with a guaranteed, predictable cash flow. It makes sense, doesn't it? Here's what doesn't make sense. Most retirees would prefer the never-ending cash flow, yet they're building the diminishing pile of money. And that's problematic for more reasons than just happiness. So let's dive into money mistake number 2. Stashing your nest egg in long-term savings. Now, don't get me wrong. I love savings. Savings are great for your emergency fund and short-term goals, like the down payment for that beach condo. However, it's not the smart place to park your retirement fund. And here are 3 reasons why. Number 1, the interest rates on regular savings accounts and CDs are low and constantly changing. Number 2, they rarely keep up with the average rate of inflation, which means over time your long-term savings lose purchasing power. So yeah, in a bank, your money's safe, but it doesn't grow. In fact, when you factor in inflation, the true value of your nest egg actually shrinks. So you're left with less and less money every year. And reason number 3, your savings are nothing more than piles of money that diminish as you make withdrawals, especially if those withdrawals are larger than the interest earned. Meaning, over the course of your retirement, you could completely deplete your accounts. This is why over half of working Americans also rely on market-based retirement accounts like an employer-provided 401k or 403b, a traditional or Roth IRA, or even a broker-managed stock portfolio. They want their money to grow and to continue to grow even as they make withdrawals. And this sets retirees up to make money mistake number 3, leaving your retirement fund exposed to market risk and potential loss. Here's the thing about market-based accounts. They're ideal for people in their 20s, 30s, and 40s, but not for people in their 50s, 60s, or 70s who are nearing retirement or already retired. And that's because of the market risk. You already know that in a bull market, when share prices are rising, your portfolio grows in value and you make money. And you probably also know that in a bear market, when share prices are falling, your portfolio decreases in value and you lose money. What you may not realize is this: depending on the degree of that price dip, your losses could be minor or they could be massive. One recession could wipe out hundreds of thousands of dollars in retirement funds and cost you years of much needed money. An unfortunate example of this is my client Theodore. He was a year from retirement when he reached out, and he was desperate to protect what money he had left after losing $200,000 in his 401k due to market fluctuations. Theodore had no idea what would happen in the market over the next 365 days. In a best case scenario, his portfolio might recover a little bit. In a worst case scenario, he could lose even more money. And if he did, he wouldn't be able to retire. For him, further losses weren't worth the risk. So we rolled the funds from his 401k into a guaranteed lifetime income investment that was completely shielded from market losses. I'm telling you this because market risk is a real threat to your financial stability during retirement, and so many retirees make the mistake of leaving their funds exposed. Now, most brokers will brush off these losses as paper losses, saying, you only truly lose money if you sell at those lower prices, right? The stock market is repetitive. So if you wait for the market to rebound, you'll eventually see your portfolio return to previous highs. And that's technically true. However, what brokers ignore is this: soon-to-be and recent retirees like you don't have 5, 6, or 7 years to wait for their portfolio to recover, which is, on average, how long it takes. Note that I said recover, not grow. I say that because market losses force you and your portfolio to play catch-up for years before you see any new growth. So the bottom line is, market-based retirement accounts could potentially lose tens of thousands to hundreds of thousands of dollars in a matter of months, cost you years of much-needed future financial support, and put you at an even greater risk of running low or running out of money during retirement. They're just not worth it. Not when there's one investment type that can do it all. Grow your money, shield you from market losses, and guarantee a stream of income you can count on for the rest of your life. This special investment is called a fixed index annuity. It's a retirement product provided by life insurance companies, and it's the only investment out there that offers both risk-free growth and guaranteed lifetime income. Think of it like a personal pension plan. You fund it, it grows, and then when you retire, you get a guaranteed retirement check every month for life. If you're thinking this sounds a lot like Social Security works, well, yep, that's exactly what it is. In fact, the United States Social Security program and most employer-provided pensions are just giant annuities. So this type of investment isn't new by any means. It's just not as sexy as the stock market, which is why you may have never heard about it. Experienced investors, on the other hand, are using annuities. NBA superstar Shaquille O'Neal, for example, is a huge advocate and reports he said he put millions of dollars into his income guaranteed investment since the start of his career. That said, they're not just for famous and uber wealthy. Regular working people just like you use fixed index annuities too. Take my clients Daniela and James as an example. They're teachers in their 50s who realized they would have a significant income gap at retirement even with their combined Social Security and pension benefits. They wanted to find a safe and secure way to supplement their retirement income, so they reached out to me. I helped the couple move funds from their market-exposed IRAs into 2 deferred annuities. And thanks to those investments, Daniela and James will now retire with an extra $31,000 per year in guaranteed lifetime income, raising their total annual income to almost $100,000. Another good example is my client Rodrigo, a 64-year-old retired policeman whose retirement fund was tied up in a state-sponsored deferred comp plan. Now, this plan was made up of mutual funds, which exposed him to a significant amount of market risk, and given that he was already retired, this was dangerous. After losing roughly $30,000 in the market, Rodrigo wanted to put his money somewhere safe. So I helped him fund a fixed index annuity that gave him an additional $1,100 per month or $13,200 per year in a guaranteed lifetime income versus what he was drawing before. Even better, this annuity also came with a 10% premium bonus that added $13,500 to his principal, which helped him replace almost half of the money he'd lost in the market. So as you can see, from a policeman to a school teacher to an NBA superstar, this investment is for anyone who wants risk-free growth, guaranteed lifetime income, and a stress-free, financially secure retirement. Now, I know you likely have more questions like, how do fixed index annuities work? What growth rates can I expect? How much do I have to invest? And so on. So let's dive into those details now. First, how do they work? Well, for starters, fixed index annuities are never invested in the stock market. Instead, the providing life insurance company reinvests funds into a combination of high-grade bonds and purchase call options associated with a particular index. This conservative strategy is how they give you growth on your money while you enjoy complete protection from the market. This means no matter what happens on Wall Street, you never lose a cent on your investment due to market fluctuations. It also means even if the stock market crashes horribly, your annuity investments remain protected and unaffected. That's the risk-free part. Now let's move on to growth. Fixed index annuities have 2 phases. The growth phase called accumulation and the payout phase called annuitization. The growth phase begins when you fund and defer an annuity and let the value grow over time. And that can happen in 2 ways. The first is by earning interest on your principal. Every fixed index annuity comes with a guaranteed minimum interest rate that compounds tax deferred on an annual basis. You'll always earn the minimum, and in years when the index performs better than the minimum, you'll earn even more. The second way to grow is optional, but highly recommended. And that is by adding an income rider to a deferred annuity policy. Income riders are exciting because they come with an extra guaranteed rate of return called a roll-up rate. Like the interest rate, the roll-up rate also compounds tax deferred annually, but at a much higher guaranteed rate. Right now, you can expect roll-up rates to range anywhere from 7 to 9%. Yes, you heard me right, 7 to 9%. This guaranteed roll-up rate is solely responsible for maximizing your money's growth and the size of future income payouts. We'll look at the concrete numbers here in a second, but first let's take a closer look at the mechanics. I want you to think of your investment as one annuity with 2 accounts. Account A contains your principal growing at a minimum interest rate plus any index earnings. Account B, your income account, is valued at your principal plus the roll-up earnings coming from your income rider. What this means is if you had an annuity without an income rider, your principal would earn at least its minimum interest rate and potentially extra index earnings. And that is it. You wouldn't have the income account or get roll-up earnings. On the other hand, if you had an annuity with an income rider and a roll-up rate of, say, 8%, your principal would still earn at least its minimum interest rate and potentially extra index earnings, plus your income account would earn 8% every single year. That is until you turn on your lifetime income payments. What's better is both your principal and income accounts would still grow by their respective guaranteed rates each year, no matter what happens in the market. No stock portfolio, 401k, or market-based IRA can promise you that. In my professional opinion, the income rider is essential add-on to your fixed index annuity. That's because, thanks to the roll-up rate, you get dramatically more guaranteed income per year and for life. Okay, enough theory. Let me show you a real example. On the screen, you're looking at two groups of fixed index annuities. Both are funded for $250,000 and deferred for 5 years. The only difference is the annuities in Group A have income riders. The annuities in Group B don't. Notice the difference in the income payout. The income rider in Group A would give you $8,400 to $12,000 per year in extra income versus Group B. So if we do the math over a 20-year period, that income rider would work out to $168,000 to $240,000 more in total income. That's a huge difference. And just remember, annuities guarantee lifetime income, so the total cash received will be higher the longer you live. Keep in mind though, the income rider does come with a small fee. It's about 1% and it's deducted from the principal annuity. Now I'll be honest with you, sometimes people get real hung up on this fee. And maybe you're feeling the same way right now. So I want to show you why the fee is actually worth it. Recently, I compared this rider versus no rider situation with a client who wanted to invest $300,000. Here's how the numbers worked out. Without the fee, my client would get $771,000 in guaranteed lifetime income. With the fee, however, the income payout would ring up to a whopping $1.2 million over the same period, meaning the income rider would give my client an extra $429,000 in income, and the total fees would only tally up to about $86,000. So I ask you, what investor wouldn't give $86,000 to make $429,000? It's a no-brainer deal. So I'll say it again. When you look at it from a lifetime ROI standpoint, an income rider is absolutely worth the fee if your goal is to maximize your retirement cash flow. And you should also consider this. Many investors are already paying a broker or money manager 1% no matter if their portfolio wins or loses in the market. And that broker fee comes without any promises. So why not embrace the fee that not only guarantees you'll get a retirement check every month without fail, but also ensures that the payout on those checks will be the highest number possible? Now, the income rider does have one important disclaimer. The income account and roll-up earnings are not credited to your principal account. So you can't withdraw lump sums or pass this account on to your beneficiaries. It can only ever be used for your retirement checks. And at the end of the day, I like to tell my clients, your money is either for living or for dying. If you want to maximize the cash you'll have to live on, choose the income rider so you can grow your money at a guaranteed 7 to 9% roll-up rate and lock in a much higher lifetime retirement check. Okay, that's growth. Let's move on to the payout phase. When you turn on income payments, the growth phase officially ends. The payout phase begins and you start receiving monthly checks. Your annuity income is guaranteed for life, so you'll get your check month after month after month. It doesn't matter if you live to be 85, 95, or 105. The checks will keep coming in. Plus, if you're married, you'll set it up so that your investment is a joint payout, which lets your checks continue through your spouse. so you can leave your partner with much needed financial support after you pass. And like with any investment, upon the death of the last policyholder, either you or your spouse, the remaining principal is paid to your beneficiary. Now, we've just summed up how a deferred annuity works, but sometimes clients ask me, what if I need income now? Can I still benefit from a fixed index annuity? And my answer is absolutely yes, for sure. Though the growth now, income later scenario is the most common, there are options for income now situations. This means instead of deferring the annuity and allowing the income value to grow, you activate the payout phase and start getting the checks right away. Full transparency though, an immediate payout does have downsides. Number one, you'll see lower income payments because there is no time for the annuity to grow. And number two, to guarantee a specific income amount, you may have to make larger initial investment. That said, I do use a special strategy with my clients so they can meet current and future income needs while still getting some growth. It's called annuity laddering, and it involves funding 2 or more annuities and staggering the payout so that one gives you income right away and the other gets to grow a few years at the high roll-up rate before activating the payout phase. Remember Edward, the hope I'm dead by then guy? If you don't, let's refresh. He had calculated that his 401k would last him until age 85 if he limited withdrawals to $1,750 a month, or $21,000 a year. At that point, his account would be completely depleted. Edward had no idea what to do if he lived past 85 or if he had to raise his monthly withdrawals to cover living or medical costs. So, like I mentioned earlier, I helped him roll his 401k into a fixed index annuity and increase his income to $33,000 a year, a bump of $12,000 annually, and guarantee it for life. What I haven't told you yet is that I did this using annuity laddering. This is how we set it up. He had almost $420,000 in his 401k and had immediate cash needs. Instead of putting all of his funds into one annuity with an immediate payout, which would result in less overall lifetime income, I recommended he split his funds between 2 fixed index annuities. The first was funded for $300,000 with an immediate payout. This one gave Edward a little over $20,000 a year in lifetime income starting right away. The second was funded for $100,000 and deferred for 3 years. This annuity will eventually give Edward an additional $13,000 a year in lifetime income, bringing his yearly total up to $33,000 a year and eliminating the risk of ever running out of money. I'm telling you this so you know that there are always options. It doesn't matter if you need money now or years down the road. We can design a fixed index annuity strategy that works just for you. If you'd like to discuss how to approach your specific financial situation, please schedule a free call so we can talk it through. Now, you're probably wondering, how much do you really need to invest? Well, ultimately, that depends on a few factors, like how much income you want, whether or not you add an income rider, the roll-up rate of the annuity you choose, and how many years you plan to defer it. I work with clients who put anywhere from $150,000 up to $1 million plus into fixed index annuities. It's a wide range, and it does require a personalized conversation. If you'd like me to calculate the future income and investment scenarios for your specific situation, please take a moment to schedule your free call. Okay, I do realize it's helpful to have some ballpark figures, so here you go. The average annuity investment is around $250,000. And the recommended minimum investment is $100,000. Again, this is a conversation we should customize. So I do encourage you to book a free call where we can talk through your financial goals, run the numbers, and give you more specific calculations. While we're talking about investment size, it's also important to talk through the types of funds that are best suited for fixed index annuities. Some people just assume that money is money and it doesn't matter where it comes from. And that's not entirely true. It does matter what money you invest because even though you'll have access to your principal, there are often surrender charges and limitations around withdrawals. This is a reason why you should fund a fixed index annuity with cash that you have set aside specifically for retirement, not your emergency fund, not your kids' college tuition, and not the cash you're saving for that down payment on your beach condo. Instead, use money you don't need to touch, because to lock in lifetime income, you have to park it in an annuity and leave it there. Ideal funding sources include money from existing retirement accounts like 401k or IRA, stock portfolios, long-term savings accounts or CDs, cash from the sale of a house or a business, or an inheritance you recently received. And if you're worried about going all in, don't be. Contrary to popular belief, you may not have to move all of your money into annuities. In fact, depending on your financial situation and the total amount of investable assets you have, a smaller portion of funds may be enough. It all comes down to your individual numbers. I like to call this my just enough strategy. As the name suggests, I advise clients to fund their annuity investments with just enough cash to create their desired amount of future income. No more, no less. My clients love this approach because they can invest just enough money to get risk-free growth and a guaranteed retirement check for life. Then they can do whatever they want with the rest. So with enough investable assets, you could realistically fund your annuity, keep a smaller stock portfolio for market gains, or even buy a rental property for more cash flow. Now, just to be clear, life insurance companies won't allow you to put everything into your annuity. At a minimum, you must show at least 6 months' worth of living expenses in savings. Another question people ask me is, when do I move the money to a fixed index annuity? Well, the ideal time is 5 to 10 years before you retire. And that's because the more time you let your investment compound at the 7 to 9% roll-up rate, the higher your lifetime income payouts will be. Like this image illustrates, a $250,000 annuity with an 8% roll-up rate will be worth much more in 5 years than 1 year. I'll be honest with you though, 5 to 10 years is ideal and encouraged, but in my experience, it isn't typical. You'd be surprised at how many people I work with who are either 1 to 2 years from retirement or already retired. So if you feel like you've missed your chance, you haven't. There are options available. My clients Roderico and Edward are prime examples. Roderico was 1 year from retirement when I helped him invest and get $36,000 a year in lifetime income. And Edward was already retired and making 401k withdrawals when I helped him create a lifetime income stream worth $33,000 yearly. So the bottom line is you still have the opportunity, but you should invest sooner rather than later. The good news is this. The conversation can start as early as tomorrow if you schedule your free call today. On the call, we'll discuss your financial goals, retirement timeline, and annuity options so you can get your money figured out ASAP. The issue of timing also brings up another big concern around age. People often ask me, am I too old for a fixed index annuity? My answer is usually, no, you're not. I've advised clients in their late 60s and early 70s and have successfully found that annuities work for them quite well. The important thing to know here is this. Age is only one factor. We also have to consider the income needed, your financial timeline, and the investable assets you have available so that we can see if a fixed index annuity is right for you. So please schedule a free call so we can explore your unique situation. Okay, let's get the last big concern out of the way. Is your money safe? By now, we've established that fixed index annuities are infinitely safer than market-based accounts like 401ks, IRAs, or stock portfolios. That's because with an annuity, your money is shielded from market risk and potential losses. But how do they compare to banks? I'd argue fixed index annuities are just as safe, maybe safer, than stashing your nest egg in a long-term savings account or a CD, and here's why. Number one, life insurance companies keep a much higher reserve ratio than banks do. If you're not familiar with the reserve ratio, it's the percentage of the total deposits a financial institution keeps on hand as cash reserves for withdrawals. Banks only keep 10% of total deposits on hand and use the other 90% for lending. Life insurance companies, on the other hand, keep anywhere from 80 to 100% of deposits on hand in cash reserves. This means if you needed immediate access to your money for whatever reason, your annuity carrier would have the funds available right away. Number two, much like banks and the FDIC, life insurance companies are also insured by the state guarantee associations. Policy protection limits vary from state to state. However, Most states offer between $250,000 of protection to even up to $500,000 worth of protection. Just depends on the state. So your money is definitely insured for just as much and potentially more with an annuity. Number 3, life insurance companies insure their deposits with other life insurance companies for an extra layer of financial security. And here's a quick advisor tip. To make this investment even safer, I also recommend my clients purchase annuities from life insurance companies with at least an A rating and a record of 100 years or more in business. So by now you know what fixed index annuities are and how they work. And you probably have a pretty good idea that one could be right for you. The only detail we haven't covered yet is how to get your hands on this income guaranteeing investment. In a second, I'm going to show you exactly how to do that. But before we dive in, you should know this. There are hundreds of annuities out there, and they all work differently. For example, some plans offer lower growth but higher overall payouts. Some help you cover long-term healthcare expenses. Some have more flexible surrender periods and fewer limits on withdrawals. And some offer lower minimum interest rates but come with no cap on growth. This is why, to make the best choice, you either have to become an expert on annuities or work with one. It's also why I never recommend you DIY your investment, even though a handful of life insurance companies do offer self-service options. Because the reality is, you could conduct months and months of research and still not have confident answers to critical questions like, which annuity features do I most need? Should I fund one big annuity or two smaller ones? Is this company a safe place to park my money? Do I need long-term care rider, a disability rider, or a cost of living rider? Should I choose the annuity with a higher payout but a stricter surrender period, or one with a lower payout and an easier access to the principal, and so on? Too many people reach out to me frustrated after making bad choices that left them with growth caps, mediocre roll-up rates, sky-high surrender charges, and lower payouts than they expected. And this was costing them growth and future income. Sometimes it even left them paying unnecessary fees. So it begs the question, if you want to get the highest return, maximize income payouts, and avoid extra fees, but you aren't an annuity expert, where do you find one? Well, you can't turn to life insurance companies. They're not interested in helping you compare their plans to their competitors. I mean, why would they be? And even if they did offer some guidance, how would you trust that their feedback was honest and unbiased? Don't you think they'd want to present themselves in the best possible light? That's why, hands down, the smartest option is to partner with an independent retirement planner like me with proven expertise in fixed index annuities. And why not? My annuity services are free, so getting my help won't cost you a dime. As the Guaranteed Retirement Guy, I know how to help you choose the annuities with the features that best fit your financial goals and life situation, so you can actually maximize your money's growth and your future retirement income as quickly as possible. I'm an independent retirement planner and a certified financial fiduciary with over 20 years of experience. Note that the certified financial fiduciary part is important. It means I have an obligation to act in your best interest. Just to be clear, I do work on commission. That's just how this business works. And it's how I'm able to offer my services at no cost to you. However, unlike advisors without fiduciary status, I'm not incentivized to push investment products that pay higher commissions over those that would better fit your circumstances. I personally believe you can't fully trust an advisor who makes commission-minded recommendations. And to avoid that conflict of interest, I remain independent with no secret allegiances to any specific life insurance company. In fact, my network consists of over 200 annuity carriers, so I can give you an unbiased perspective and reliable recommendations. This also means when you book your free call, I'll compare hundreds of A-rated options and bring you a short list of the best annuities for you, many of which are earning 7 to 9% in roll-up rates, have 40% higher income payouts, and offer purchase bonuses of up to 14%. So if you're interested in exploring how to use fixed index annuities to get risk-free growth, lock in lifetime income, and retire without money worries, please schedule a call with me. All you have to do is click the button on this page, choose a day and time, and answer a few questions. These calls usually last about 45 to 60 minutes, and they're held on Zoom. During our call together, we'll discuss your growth and income goals, retirement timeline, and current financial situation. Then we'll look at annuity rates and payouts, and I'll show you how those compare to your 401k or IRA investments. If it's relevant, I'll also cover some helpful tips for minimizing taxes and the little-known secret to getting 24% more money from your Social Security checks. Plus, I'll answer all of your retirement and income questions. Oh, one more thing. I'll keep my video on the whole time, so you can actually make face-to-face connection and see that you're talking to a real person who has your best interest at heart. There's absolutely no obligation to work with me. And if you're worried about a hard sell, don't be. I don't believe in aggressive, pushy tactics. In all honesty, as the only investment that gives you risk-free growth and guaranteed lifetime income, fixed index annuities basically sell themselves. I'm just here to make the process easier by helping you find the right carrier, fine-tune the details, and use smart strategies to maximize future cash flows. So what you can expect is a friendly conversation. At a minimum, you'll walk away from this call with a handful of retirement planning strategies and a complimentary customized report that shows the income you could create with fixed index annuities. Like my services, this call is also free, but they are quite popular and my calendar fills up pretty quick. So if you're at least intrigued by this investment and want to look at some annuities with me, I recommend you grab your spot today. Again, to do that, click the button on this page, choose a day and time that works for you, and answer a few questions to help me prepare. That's it. Okay, if you're still watching, I want to thank you for joining me today. Fixed index annuities are a lifesaver for so many retirees, and I'm excited to explore the possibilities with you. So grab your free call now. I am really looking forward to speaking with you here in the next few days.